Good morning, trading world. Today is November 12th, 2021, and it is just after 8 a.m. Usually I get these videos out. I'm usually done somewhere between 7:30 and 8 a.m. and then I go through the work of trying to publish, but yesterday put me into kind of a quandary. So I wanted to kind of go a little deeper and explain some things because I've been kind of hinting or saying that the market is become very inefficient at pricing in risk, which makes what I do so much harder. And yesterday we had a close in a particular place that kind of makes everything very hard. So rather than go through all of the different scenarios, I'm going to try to prepare you because there's one scenario that has the highest probability of happening today. But that one scenario has so many different variations of how it could play out. I'm going to try to spend most of the time preparing you for those variations. So, like I said, each morning I come in and take information from yesterday's close and assimilate what could possibly happen today. And like I just briefed you, today will be harder than most, and I'm trying to dig in a little deeper so I can give you a brief look as to why getting probabilities on today's scenario is so much harder. And in order for me to explain that, we're going to have to understand a little bit about standard deviation. Standard deviation plays a big part in just about all pricing models, especially stock and option theoretics. It is how insurance companies price how much you pay for insurance. And the reason so is that throughout everything, you have what's called a mean. A mean is similar to an average, but not an average. And by using this mean and standard deviation, they kind of figure, or by using statistics, that about 68% of statistical occurrences happen within a certain area around the mean. Let me go back and explain to you exactly what, or give you the definition of standard deviation. Standard deviation is a measure of the amount of variation or dispersion in a set of values. And for me, the higher the deviation, the bigger the range. The lower the deviation, the smaller the range. And we can view this graphically by using the bell curve. And let's see. There we go. This is a bell curve. And alluding to what I was saying earlier, with this being the mean, 68% of all occurrences will happen within this area around the mean. And we can go out even further. 95% of all occurrences will happen within this area away from the mean, or within the mean. And this is how standard deviations, or the basis of standard deviations, are looked at. Now, we apply this to stock and options pricing this way. If we turn the bell curve on its side, do that. Let's get it down here. So if we place it on its side, I should have cropped this. If we place the bell curve on its side, and let's say that the mean of the SPY is right around this area, this 464 area, we can get a pretty good statistical analysis of us returning to the mean, or at least somewhere around the mean. So we could say that it's better, or the best place to enter, statistically speaking, would be in the yellow and red area, because by entering in that yellow or red area, we have a 85 to 86% chance in returning to the mean area. So those are great statistical odds. However, what happens when you close at the mean? When you close at the mean, it gives you absolutely no bias either way. It's basically a 50-50 chance that we could go either way. And the reason I'm explaining this is because yesterday the SPY closed exactly at the mean, which means today we have a 50% chance of going either way. And that's the reason why it is so hard to price out or do probabilities on scenarios that could take place today. I'm hoping that this kind of touches home and helps, and it kind of gives you a glimpse into what I do on a statistical basis, even though I may not bring it up, but there's a lot more that goes into this of what I do when pricing out scenarios, but this is a big part of it, and I just kind of wanted to touch on it, the behind the scenes part, to say, and again, let me drum this into everyone's head, that there is no 100% probability in trading. The only 100% probability in trading is that you will lose money at some point. That is the only 100% probability that I know to be true in any form of trading. So, with saying that, what I do is basically a guide to kind of help prepare us if we see certain things and how to react when we see those certain things. With that being explained, let's get into today's scenario. But even before I get into today's scenario, I have to go into the mechanics of a range day, because the highest probability that I have today is going to be for a crazy range day. And I know some people, they'll look at the probabilities and see that I call range day, and it may not go the path that I plotted, but indeed it is still a range day. Like we got yesterday. Yesterday I kind of had that feeling that it was going to be a crazy range day. So I wanted to touch more on the different variations of a range day. We can pretty much ignore the chart behind us for the moment while I get into the different variations of a range day. All right, and again, the reason why I'm doing this today is that there are so many ways that it could go today, so many variations of a range day, that it's hard to predict and plot a path. And on range days, you have to pretty much throw out moving averages because they are no good. You really have to lean on your indicators and being able to see convergence and divergence. Other indicators that work really good on range day are your Bollinger Bands. Anything that kind of plots standard deviation to a degree. There are a few more indicators, but the main one that comes to mind are your Bollinger Bands. So, in looking at the different variations of a range day, this is the typical range day. We have a high, we have a low, and we ping pong back and forth in between that high and low. This is the basis for all range days. It doesn't matter whether we start high or start low. The only thing that matters is that we establish highs and lows and basically ping pong back and forth between the two. Now, the different variations, I'm only going to get into a few, because there are so many ways that this can go. You have, in my opinion, you have range days that have a bullish bias, you have range days that have a bearish bias, and then you have range days that have a squeeze element in the structure. First, let's look at the bullish range day. On a bullish range day, we have the same principles. You establish a high at some point, you establish a low. And price action first establishes the high, we pull back, making a higher low, and we keep pushing the boundaries of the high. And this is a range day with a bullish bias. This is how I see a range day with a bullish bias. So we basically establish a high, establish a low, and we keep pushing the boundaries of that high throughout the day. We ping pong back and forth, but still we push the boundaries of the high. And usually there are key things that I use to help identify range days and trend days. And usually the main difference between range days and trend days, it's usually what happens in the overnight session. If it leads to a gap up or a gap down, or if activity was at a minimum, we stayed within a tight range. This usually helps me identify the difference between a range day and a trend day, along with the other factors. But this is, again, what I consider to be a range day with a bullish bias. Now, as you can imagine, a range day with a bearish bias is the exact opposite. We push the boundary of the lows. We go here, come back up to a high, we push the boundary of the low, and we ping pong back and forth. That is a range day with a bearish bias. Now, even something more complicated, and which I think is what we're facing today, we're going to have a range day that's going to have a squeeze element to it. And what I mean by squeeze, usually we're all taught as traders in some form or fashion, if you use any part of technical trading, you look for symmetrical triangles. These are usually squeezes or wedges. They inform you of a pending breakout coming, because it's that tightening of the spring, that spring being compressed just before it jumps out. And we get a wedge type element just before we break out. Now, usually when we're into some type of wedge play, we're trading within a range. It is range, or range day principle to some degree, depending on what time frame we're looking at. But when we have a range day with a squeeze element involved, or a wedge, this is what takes place. We have the range day, we establish a high, we establish a low, and we pretty much ping pong back and forth. But at some point, we get a breakout where price takes off. And usually this happens at the end of trends, or when momentum is shifting to another direction. If momentum was up and then we're shifting into a downward momentum, these are the things that identify those areas. So this is what we have to look out for today, because in my probabilities, we have a 50% chance of a range day. And in that range day, we have a great chance for a breakout. So I wanted to key you on being able to spot those. And like I said earlier, when we are in a range day, you really have to key on convergence and divergence. No matter what the indicator you use, you really have to understand the principles of convergence and divergence to help key you when we're making a range low or a range high. And usually what works easiest for me is that I usually look for 2 points to establish a range. If we hit those 2 points, I'll usually draw a line on the chart and use that as a range point or a point of entry. And this is also how I define the risk. Because if I enter at this point, wherever the highest bar was, that's usually going to be my stop, or that tail that lets me know if it breaks past this point, the trade is wrong and it's time to exit. So that is pretty much most of what I can cover when it comes to a range day. Now, getting into today's scenario. All right, when it comes to today's scenario, I'm only going to post one scenario. It doesn't mean that there aren't likely other scenarios. They just have a very low probability. And there were so many variations of this one scenario that it was going to take up all of the time trying to explain this. All right. On the range day, I'm going to call a crazy range day structure. The way, the biggest probability of how I see things happening today is that we come off the opening and we establish a resistance area around 465. Once we bump into resistance there, look at your indicators for divergence. If we diverge, we're going to go down and probably establish the first low or range low of the day, which is probably going to be around 463. And from there, we could see some sideways chop, probably a pullback, making us think we're going to go back up. But again, watch your indicators. Convergence and divergence are key. Likely, we're going to see a dip below 463. If we dip below 463, 461 is that area where it's kind of like the gatekeeper for things going completely off the handle. So look to find support around that 461 area. It is possible that we can overshoot 461 and wind up somewhere down below 461, but this is just a guide. So if we find support at 461 and we don't dip too much below, because if we do go below 461, if we get down to that 460 area, it will be of supreme importance to watch the indicators, watch your big tech companies, Nvidia and Tesla, because if they come off the rails at this point, we could fall kind of far. And the reason that there's not like a specific level that I can point to at this point is because that 461 area is where hedge funds and all the big market makers, this is where they have kind of drawn that line in the sand as far as risk. Anything below this point, we're off script. And the market makers and hedge funds, they have to start adjusting. And when they start adjusting, there is no telling where we can end up at. So that 461 area is a key level to watch. And we have like a 5% area of variance around this 461 area, which kind of acts like a magnet. If we're within the vicinity of 461, so if we're at 461 and a half, either way, 461 and a half down to 460 and a half, we're still basically on that 461 level, and it's going to draw and keep us drawn into it like a magnet. And one thing to watch for to see that we are going to peel off the 461 area is to watch your volume. You'll see a big volume bar jump way above the average. And that's going to be a key sign that we're about to peel off the 461 area. Which way? It's going to be hard to say. This is something that you have to feel and watch in real time. So if we pop back up above the 461 and we get a huge volume bar, a bull volume bar that pops up off the 461 area, we can go for a while. We could possibly see 466 at some point today or beyond. We could actually begin to fly a little bit today. And I kind of alluded yesterday into, there's some things cooking under the surface that kind of smells like a bounce is being put together. In me saying that, even though I can kind of see some things percolating under the surface to kind of give us hints at a bounce, don't be surprised if that bounce is short-lived. If it's just a bounce that's going to give us, what I'm looking for is just a better place to enter in short. Because in my eyes right now, rallies are going to start to be sold into. We've reached that level, especially with the momentum cross on the daily. We're going to reach that territory where all rallies are going to start to be sold into. So don't be surprised if this ends up here at the end of the day. And if we get a fall from grace at the end of the day in the last 5 minutes of the market, don't be surprised if we come in gap down almost 20 or 30 points on the S&P. Don't be surprised, especially if it lines up this way and we get the fall from grace going into the close. So that is the pre-market analysis for today, or my pre-market outlook. Again, always know your risk. These are days where if you're not competent in what you are looking at as far as convergence and divergence, it's better to sit on the sidelines, because the same as trend days. When you buck the trend, you could usually chew up your whole account on days like that. On the range day side, this is one of those dangerous days on the range day side. So be careful. Good luck. Wishing you successful trading. Have a great day.